All righty. 14 people in here. Wow, this is epic. I love it. All right, cool. Well, I think we're gonna get started here. Thanks for joining in, everyone. Really appreciate it. It's cool turnout. First of all, thank you all for being in the Strong Trading Discord. As you guys know, it's just something free, educational. I'm just trying to bring together trading and lifting, so that's why a lot of you are here. So I appreciate all of you contributing, asking questions. You know, the Discord is just a place for everyone just to learn. And like I think that's what is cool and unique about it, because I've been in a lot of other communities and Discord and stuff like that, and everything is kind of really focused on one style of trading. And you know, sometimes if you talk about one thing, it's almost like frowned upon. But as a reminder, trading is your own individual business. So it's like if you use something that doesn't make sense to someone else, it's like it doesn't mean it's wrong necessarily, but just like figure out what makes sense to you. And the only way to do that is just through deliberate practice, documenting, all that type of stuff. And so if you can take a gem from something that you're learning and it creates some sort of confluence, such as ICT. So a little background on this, like I am very unfamiliar with all ICT stuff. And Decipher the Algo, my dude Chris. Background on that real quick too. Me and Chris have competed in powerlifting for a long time. We're really good friends and both got into trading very similar times. So yeah, we just always kind of chatted back and forth and kind of had that connection, which is super cool. And Chris has been learning a lot about all these ICT models, all these ICT concepts. And as you guys probably know, if you go on ICT's YouTube, it's literally just a clusterfuck of a bunch of stuff. And so that's kind of why I asked Chris. I was like, are you down to do like an intro to ICT? Because I was looking through some of his stuff and I just couldn't find really where to start. And, you know, pretty much the basis of this is going to be on fair value gaps and liquidity. And yeah, it's just an opportunity to learn. So last thing, this is not financial advice. This is strictly education. You know, if you go lose your whole portfolio for full porting, that's your fault, not any of ours. So um, we're gonna kick it off. Chris, take it away, brother. All you.
Alrighty, thank you. Yeah, thank you for joining, guys. We'll just get right into it. So for today's discussion, I titled it "The Driver Behind Price Delivery." We'll get into the meaning of that pretty shortly. So my main three objectives for today: I want to provide you with a deeper understanding on why price moves. I want to teach you how to view markets through an institutional lens, and I want to give you the tools that can immediately be put into your trading, whether it's analysis or execution. So to frame today's discussion, this is what we're talking about: liquidity through just the medium of swing points, and inefficiency / imbalance, which is the fair value gap. So right here on this first diagram, I don't know if you can see my mouse, can you? But either way, this first swing point, that'd be external range liquidity. This is internal range liquidity. Right here, this would be relative equal lows in the form of sell stops underneath. And right here, this little example is a fair value gap. So what moves markets? Like that's the question that everyone should be asking anytime you're looking at price. Let's start with retail trading has popularized the use of moving averages, oscillators, and various volume indicators. There's thousands of books on the topic, but little have done to eliminate the high failure rate of traders. So my question is, and at least for this discussion, what weight do these hold? Is there an exception to these supposed rules? When and where does this logic work? And when does it fail? So when I got into trading, that's what my charts look like. And that's why I hang on to this chart, because it just reminds me of like the nonsense that's out there in markets. I post this in the Discord from time to time, but like at the end of the day, the meaning behind it, it's like you can't see price. When you have all this shit on your chart, you cannot see price. And that's what we're trading. We're not trading the moving average. We don't get paid on an EMA cross. We get paid on price. So today, what I say is we're going to put all that to the side. Whatever you might know about markets, whatever you use for this discussion, at least for the frame of this discussion, let's just put that to the side. No indicators, no averages, no volume, just a time-based price chart. So let's begin. This is a good visual representation of what market mechanics, or at least the market mechanics that we're going to be considering. If we know that the many fail in trading, the logical conclusion is that there's a few that succeed, because for every trade, there's a counterparty. And the market efficiency paradigm, this is a machine. Whether it's a liquidity provider, a central bank, or whatever frame you want to look at it from, There was someone on the other side of your trade. When you get stopped, someone bought it. When you're chasing price, someone's unloading. And that's what this is representing. So what smart money does is the opposite of retail. If we know that a majority of breakouts fail, these are the people trading the other side of the breakout. It's order pairing at the end of the day. So into liquidity, there are two truths of the market. At least in this discussion, there's many, but these are two truths. Below swing lows, there are sell stops. Above swing highs, there are buy stops. Now, this is something that we know no matter what, how, why, when, or where, there's going to be traders that are positioned. There's always a reason to get long, whether it's a moon phase or whatever you believe in. There's a reason to get long and there's a reason to get short. So it's either you see the liquidity or simply you be the liquidity. And just another question. Have you ever noticed how price never leaves swing points intact when there's a big news release? Why is that? This is liquidity. This is also liquidity. For the scope of this discussion, this is what we're going to be looking at. So a retail-minded trader might say that, oh, these are relatively equal highs, so that's strong resistance. Let me go ahead and get short towards the top of that blue line. And we see that on the bottom, there's a strong low that was formed. If we take the position of a long, we can assume that someone's long from there and their stop is below that. So with this in mind, the way that we want to view liquidity is that it's either going to be utilized for an entry or an exit by smart money. So when you have relatively equal highs that are left cleanly intact, you can almost bet with certainty that they'll be revisited. So the question is, why would it purge lower to only go higher? And my question for you is, why would they leave longs in a position to make money? If the market feeds on liquidity, it's going to want those sell stops below. That's where they're getting in. That's where the machine is cannibalizing the liquidity. If the goal is to ultimately move price higher, chances are it's going to take liquidity lower first. So through the lens of liquidity, we are actively targeting old highs or lows for our exits. This is directly opposed to retail beliefs of support and resistance. The inherent flaw is in believing that your stops are safe because of some imaginary line. Mm-hmm. I know a lot of traders, they say they trade support and resistance, but they trade support that's been broken, which if you really think about it, that's not support. That's a rate on liquidity. So there are some various functions of price. Markets will be doing one of the following. They're either seeking liquidity, they're seeking an inefficiency, or they're consolidating, otherwise known as generating liquidity. So at the top, you could see some equal highs taken, and then that final high taken before price reverses. And then on that lower chart, you can see what I highlighted as a fair value gap. And you see price consolidating while holding that as essentially what you would imagine support would do. That's what these fair value gaps do. Without further ado, so on this first chart on the left, we see three candles that comprise the fair value gap. That wide range candle in the middle, that's what frames the fair value gap. And on each side, there's no overlapping wicks. That creates an inefficiency or an imbalance in price that will often be retested and or respected. They're highly reactive areas in price. I mean, you could take my word for it. I don't recommend it. I recommend you going into your charts and just watching this over time, and you'll be surprised how often this stuff pans out. It's insane. And then on the right side, we have an example of a bearish fair value gap. So fair value gaps provide a safe way to buy as price is dropping or to short as price is rallying. We don't wait for a reaction or a price action signal. This is not how we trade them. Instead, we're going to get short at an area that's likely to create that reaction. So just ask yourself, how great would it be to be short at the top of a wick or long at the bottom of a hammer? That's often what these scenarios in price, like that's where they happen. And you'll see that just by going through charts, you'll see that that top of that tail respects some sort of fair value gap on some time frame. These specific areas act as magnets for price. This is due to gaps in two-sided delivery on the smallest time frames. if you think about like second charts, it will often show gapping action in these large bodied candles. Basically, markets, since the inception of electronic trading, they are highly efficient, meaning if we're thinking about it through the lens of that market efficiency paradigm, there's a lot of swiping action when price moves up. It doesn't move up very cleanly. So anytime there's a broad move in one direction, markets will want to offer the opposing direction of price delivery in that range before continuing the primary move. Sounds like a lot. I promise you it's a lot more simple when you see it in action. So why does this matter? Like, why should you care? Well, we know that price will want to rebalance these areas. And we know that because I'm telling you. And you'll have to go through your price data and confirm or deny that. But because of that, we are given a repeatable entry formation. This is your $1 million trading model, just to put it simply. So to bring it all together, I'm going to give you a bare bones trading model. 4 easy steps. You're going to look for a run above or below an old high or low. I want you to observe a price displacement that creates a fair value gap. And now you're going to wait for a retracement into that fair value gap, and you're going to target an opposing pool of liquidity. Simple as that. So what do we have here? We have a run above an old high that creates a displacement lower. We see the fair value gap. We see the retracement into the fair value gap, and we see a drop with speed. So these are all the elements of an effective trading model. This is your pullback trading model on steroids.
Quick question. What time frame specifically does it matter on a time frame when you look for this stuff? Could it be done on any time frame? Like, how do you need to see a certain like swing highs or lows when it comes to this? Like,
right.
The first thing you look for.
Yeah. So, I mean, the cool thing about this is through the lens of ICT, price is fractal. I mean, that's a belief that I know a lot of us share regardless of modality of trading. So you can use this on any time frame. When I first started learning about this stuff, I remember seeing Ryan talk about, right in the call right now, talk about a daily fair value gap on NQ or ES. It was overhead for price. And I'm like, but I like the longs. And this is before I knew any of this stuff. I like the longs, and it just rejected. It was like a session or two later, reject. I'm like, what the fuck? So that's where I started to get my interest in it, because I would see it on the higher time frames. And from there, I actually did a lot of my case study on the daily chart, just looking at all the fair value gaps, because believe it or not, there's a ton on the daily. So these concepts are universal, whether you're on a weekly chart or a 5-second chart. I mean, I've showed you guys in the Discord, I posted these 15-second execution charts on, especially on like the new week opening gaps and stuff. And yeah, there's setups on every single time frame. But yeah, to continue with this, we have just a few more slides and we'll open up for a Q&A. There's the execution. Very simple. I mean, if you're looking at this, this is maybe 4 minutes in the trade with, I don't know, like 3 handles of drawdown for 50, 60 points, whatever that is. I mean, you can just see, this is one of the examples from, I think it was like last week. So bringing it all together, Smart Money Concept states that charts will leave behind clues of what price is preparing to do next. The fair value gap is a prime example. Never chase the displacement, just wait for the fair value gap to be tagged. And lastly, the concept of liquidity states that the price run will end once sufficient liquidity has been purged. So like the break of daily support to only rally higher. There's almost always a liquidity-based reason for price to revert. And if you find yourself trying to catch a knife and you're just not getting any traction on a long, or you're just shorting yourself into oblivion, wait for a liquidity to be taken. It may, especially if it's time-based liquidity, like a prior high on a daily or a weekly, it will make your life a lot easier. So with that being said, it can be liquidity that causes price to change in its delivery, or it could be an imbalance. Oftentimes I'll show you like a 15-minute chart with a fair value gap, and that's where I'm looking for intraday reversals off of that. And there won't be necessarily an intraday reversal signal. I'll be buying the low and just selling, 50 handles higher, but it's because of that fair value gap on the higher time frame. So that's all. We'd like to give a special thanks to Strong Trading for organizing this. All Concepts discussed in today's lecture were derived from the Inner Circle Trader and my personal understanding and application of these principles. So would like to open this up for questions for whoever might have questions.
Hell yeah. I'll start first real quick. For fair gap, so this is something actually I still struggle with when I look at fair value gaps in general, is do you want to see it closer to a swing high generally? Like what if we're in consolidation and you see three candles in a row, like that, like kind of like being able to draw them in various time frames? That's still something I'm trying to train my eyes to see. And I don't know what carries more weight. Like if we have a fair value gap that is coming from a high or coming from a low, basically, like, like what provides the most value in terms of that?
So that's a good question. I would say it's very similar to how we learned how to trade intraday, where when you're looking for a pullback, you're going to be looking for something in the lower portion of that price run. So if you take, let's just say you're trading like a reversal, right? So you're trying to trade back to a session high or something. You don't necessarily want to be taking the pullbacks that are in the upper 50% of that price run. It's pretty close to the point of origin that you're going to want to be looking for these because that's where you're going to get the most benefit of it. So like in this example, this one has very few fair value gaps. You see there's a bit of an acceleration towards the downside,
Mhm.
but this was just the first fair value gap that formed in that price run. That's the one I'm going to want to be looking for. It's going to be the one that comes right off of that run.
Okay, so
So
so real quick, so actually keep this chart up. This is actually a good example. So for me, like if I saw something like, hold on, I'm trying to annotate on this real quick. Um like basically around, okay, so like let's call it like one, you have two, and then three with the fair value gap here. If we're like, wait, see how like this is in succession of like a bunch of candles. That's
yeah,
kind of the question, is like, where would I start within all of this to look for a fair value gap?
so with that, I mean, yes, there is a fair value gap, and we could kind of see that it was inverted ahead of that price run. So like if you, I don't know, move over or starts rallying, it actually gets inverted. So like anything else, you can take things in isolation and it gets a little tricky. So when if you see just a fair value gap by itself in random, like this to me tells me more that price was delivering lower. And unfortunately, I don't have the time axis on this, but time does play a factor in this. So for this model, in that section that you're talking about,
Mhm.
it's kind of difficult because we don't have a run above an old high
Okay.
if we're trying to get short. Then that's at least for this specific example or this specific model, that's what I like to see as a prerequisite. So if we think of it as like a recipe, it's just 4 steps. So we want to see a run above an old high. And like, don't get me wrong, fair value gaps in by themselves, they can hold value. So like past this circle, if you go where it starts to rally and creates what you'd like consider like a little flag,
Mhm.
that happens at the majority of that bottom of that fair value gap. So like it does play a role in the formation when it's starting to recover that initial drop.
Mhm.
So if that like the way I look at it, it's like a roadmap. Like fair value gaps, they're just something on charts and they either act as resistance, but like as you start to explore the stuff more, you'll see them invert. So like that's what you get in this example right here, where it literally breaks above this old high. So and like you can look at it from this perspective too. So you have this initial low, and then it breaks below it on that swing low where it's circled, and
Mhm.
then it rallies. So that tells you can start looking for buys technically back up to this old high. So that's a cool part about price. And I know it's a little off topic for your question, but that's what I'm seeing in this example on that, at least for that portion of price. So I don't
Okay.
know if that helps, but that's how I see it.
Yeah, it's because like I said, I think like just the most confusing thing to me still is like looking at that like kind of 3 bar play of the fair value gap. Because like
Uh
over here,
huh.
I see this really clear. It's like right
Yeah.
here, you have a touch here. So like, yeah, exactly right here is the fair value gap. And you had it from a high into a big
Hmm.
like extension move, impulse move, and then it comes back and retraces, which also is about 50%. So it's like, you kind of have some
Yeah.
so I understand that. Um, so I guess just still like me trying to train my eyes to understand like, I'm like, okay, well, why wouldn't something like I said, like I guess that first example I gave was good, or even like down here, um Like you have like 1, 2, 3. So it's like something like this area. I'm like, why wouldn't this be like a fair value gap? That's kind of like my thing.
Yeah,
I'm still a little bit confused over it, and I'm trying to train my eyes to understand like, what's the easiest way to start looking for them. But from what it sounds like
right.
you're explaining, it best comes if we put in some sort of swing high or swing low and then kind of go from
Mhm. Yep. So any sort of displacement, and then like about a 50%, like you're saying, that's typically like if this fair value gap was right at the low, it'd get a little challenging. You want to see it retrace a bit. So whatever that displacement leg is, as close to 50 would be ideal. But
there.
yeah, to answer about what you're talking about with these, yeah, there is fair value gaps here. Sometimes they don't get filled. Like that's a signature of really strong price delivery. When price is just running higher and then leaving multiple unfilled gaps, that's what you consider like a breakaway gap. And that's kind of what I labeled in this. So when I was actually in this trade, you saw this fair value gap, it just got left. And when I took this trade, I wrote breakaway gap before it proved it was a breakaway gap because I expected this to be left open. And that's something you'll get from just using these concepts over time.
Mhm.
You'll start to understand when are these fair value gaps likely to get left behind. And what that tells you is that price is ready to run. It's not trying to hang around. So like as much as you might want like a retracement into this, it's just not going to give it to you sometimes.
Mhm. Okay. Cool. No, yeah, that helps clear it up and like it'll start training my eyes more, which is awesome. We've got a bunch of questions here in the chat. I don't want to open up everyone's mic, so I think I'm just going to start reading them to you, and then you can just
Cool.
answer as we go. Um, let's start with so Anthony, you said, can you go over how to find the fair value gap? I think I kind of just that was my question, so hopefully that cleared it up. Kim, some of your favorite fair value gap entry examples from this week for NQ. So I don't know if he has other charts up, but let's
Yeah, I don't really have
yeah, let's
anything.
let's just well
I mean,
maybe
I
you can
did
post
post
something
one in the
later in the
chat
Discord or
yesterday.
something like that. We'll just try to stay on these slides for now. Do they say that we have to wait for a swing inside the fair value gap?
Yeah,
Um,
you're gonna want to see it retested at least for like this model. That's the main benefit. So let's see if I can post this. This is a fair value gap from this week. So it's a little bit different, but we see a shift in market structure, and then a fair value gap, and then a drop below sell side liquidity. So
mhm,
that's one example, I think, from yesterday. I think it was from yesterday PM session. So that's one of my favorite examples. It's a little outside the scope of this specific discussion, but you still see it. Displacement leg, retracement into a fair value gap. And what I will say about this specific example is you see that there's two fair value gaps. What you're gonna have to do if you're trading something like this is you're gonna have to be willing to risk above this guy because it could have tagged in here before dropping lower.
mhm,
So that's a component. You never know if there's two, you never know which one's going to get filled. You should anticipate that obviously the bottom one's going to get filled because I mean, can't really gap over it. But if it fills to the top and it still goes, it'd be a bummer if you got stopped out. So like with that, you'd have to go in with a little more reduced size if that's outside of your scope. But I mean, we're talking it's like an extra 10 handles or something on NQ. So it's not completely devastating,
yeah. So
you
I
know,
mean,
for
even on this example right here, like see, honestly, I'm still trying to train my eyes to like look at this and see this, but like the fair value gap that you're looking for, um, somewhere like is it start at with this candle right here, like this first one? Because this is
uh-huh.
one, so it's 1, 2, 3, and then generally it would be, wouldn't it be here?
Yeah, so that's one. And then there's also one right below it as well. So there's a twofer right there. So the one I highlighted is the one I entered on.
Where is that? How do you find that fair value gap exactly?
Oh, yeah, the one below would just be that right there, and then that right there.
Oh, so you can still do it with just two candles. See,
So yeah,
I'm thinking it's a
it's
strict
the
thing where it's only three. That's kind of like my confusing part on it too.
yeah, so it's three candles right next to each other. So like they don't have to be completely down. Like they could be up or down next to each other. But like, you know, for example, there'd be a fair value gap right here. I mean, you know, and this obviously gets inverted, so you can look at it that way as well.
Okay. Okay, that makes a bit more sense. You're basically just looking for like a big some sort of combination of three candles,
Yep.
but an
That has a
extension move is the bigger picture part of it.
as long as the wicks don't overlap, like if it was like this, I got my dog harassing me right now. But yeah, as long as the wicks don't overlap, like you have a fair value gap.
Okay. Okay.
That's the main premise.
Okay. Next question. Jeff said, how do you decipher a true fair value gap on a 15-minute or 1 hour versus the 2 minute when a 30-minute time frame may have already been filled, but the 1 hour has not? Maybe I'm missing.
Yeah, that's a good question. Sometimes there's like a bit of disagreement with the amongst the elders, right? So sometimes you see an hourly fair value gap, but like you have to ask yourself, like, what am I going to do with this? So what I actually like to do, and like this is the real like nuts and bolts of it, is I really like the 15 and 30. Like if I can find a very concise fair value gap, like a very, very tight one, that I can actually risk off of, that I like to treat more for like entries. But if it's too wide, and this is a little bit nuanced, I almost like to treat it like a void. So like if the fair value gap is like, let's say this wide and you're trying to get long like right here, like who's to say it doesn't go all the way down? Like, and imagine this is like 150 handles on NQ. Like, what good does that do me?
Yeah.
You know? And if we're looking at it, like maybe it's inside a giant price run and it's a majority of it, like there's not necessarily much edge in that alone. But like, let's say we refine to the hourly, and this is something that Ryan does pretty well. He'll refine to like the 5 minute from like 3 days ago, and you have the fair value gap to like 10 points. So like if the fair value gap is like here, and this is where we could start to use something like a fib retracement. I know you guys will see me use like the 61.8, 70, 78.6 fibs. So those deep fibs, if it aligns with one of those, like then you got a pretty decent trade entry. And that's it starts to expand into another model of the optimal trade entry. But that's what I personally like to do. So if it's like too big of a fair value gap, sometimes it could be a bit of like a red herring, and it's not going to help you as much as like a more refined 15 would. But like the main idea is if it's under 50% of whatever price leg it's in, like that's a good pullback. If it's too high, it might want to rebalance lower before going higher. So like that's what you have to be careful of with like the higher up fair value gaps.
Okay. I think
I hope that helps.
yeah, for sure. That makes sense. Because I mean, just a big takeaway on that too, just for everyone is, you still have to have a plan. It's like,
Yes.
risk is still there. We got to remember, it's like just because you see some sort of fair value gap or something,
Yes.
it's like, well, yeah, maybe it's going to come test it, but like, can you handle 100 points of drawdown on risk? Probably not. So, just if you have a fair value gap or a setup that you see, and then you see another fair value gap like way below it or something, and the first one doesn't hold, it's like, okay, well, you need to take your stop and then like reassess. And
Yes.
that's just
Yeah, like it's that's why I like this stuff so much, because it's just all it is a way to be a little more precise with the way that we already read price action.
Mhm.
So like understanding like the concept of like swing highs and swing lows, like and how price should gyrate, and just understanding how intraday price action moves. Like if, for example, the E-mini runs 20 handles and then gives me a little fair value gap, I'm not going to expect 20 more handles out of it. Not in this current climate. That would be atypical.
Yeah.
So like those types of things can be an indication. Like I gave an example of NQ yesterday where there was a fair value gap above the high a day break and it inverted. And that's what we were talking about in the chat.
Yeah. So actually, I kind
And
of this next question real quick.
yeah.
How do you know when it's a fair value gap versus an inverse fair value gap? I would assume is IFVG.
Yep.
Like if it's bullish, if it's inverse fair value gap, you want to short, but if it's a normal fair value gap, you want a retracement to go long.
Yeah. So I mean, those are good questions. Main point will be higher time frame alignment. Like if you're trying to be highly bullish when it's a heavy tape, your fair value gaps are going to fail and they're going to invert on you. So the second order thinking would be, how do I use that to my benefit? You're going to want to see bearish fair value gaps failing if you're long or if you're bull biased. So that's the main takeaway. And like over time, you'll start to get an idea of like a fair value gap that might look just a little too fat and just a little too obvious. Like this is a chart I put in the chat yesterday. So you had the break above highs. This was a level of buy side liquidity up here. And it put in this, like, it just a very obvious, like, bull flag. And my thought process is, well, that's not going to hold. And that's a fair value gap right there. But I drew it orange because I anticipated this failing. And there's one below it. And that's where you see most of the entry. And there's a few people talking about the 800 entry. And it would have gave you a nice run down to the sell side. I mean, that's 60 handles or so,
Yeah.
57 handles.
Yeah.
So, like, it's just a little bit with experience, but also just understanding the context. Like if this had just taken liquidity to the buy side, like why would it? We're not breakout retest traders. That's not the model for this. Like
Mhm.
it works occasionally, but not in this instance. So with something like this, when you see a move like that, like you're almost expecting them to fail when you understand that liquidity was just taken, and we're not going to be rewarding the breakout and retest traders. Like that's not the condition for it, especially considering that yesterday was an inside day.
Yeah. And it's actually this exact chart you have up. This is where, you guys, if you have certain like levels or indicators that help you, and then you can see stuff like this and it adds more edge to you, that's where it's really going to come the most benefit. Because like for me yesterday, like where we topped out at 17,850-ish, like that was my near-term volume point of control in NQ. So like when we came up there and slowed down, I was like, okay, well, this could totally just be a false breakout here. And then like you posted this chart and then it starting to fail. And so I was like,
Mhm.
for me, kind of from stuff you've been posting, what I've been learning, I was like, literally, I got short up here and I was like, this is going to dump and run this sell side liquidity. Like, and
Yep.
sure enough, it did. I got a little kind of caught up in here, but it ended up playing out. So later when I went to review, I was like, okay, well, like, my volume point of control in conjunction with what I've learned from Chris from like sell side liquidity made this an easy target. And once I saw it play out, it just kind of builds more conviction in, my thesis, my understanding of like what I'm looking for.
Yeah, I mean, beautifully said. And the great part about this is like the chart leaves these for you. Like it leaves these fair value gaps. So like when you know where this is your draw on liquidity, that's your sell side. That's where that's where your focus is. And from there, any piece of information that can be used as either a support or resistance, you're going to want to add to your chart. Like if these fair value gaps held, then they're obviously not an inverse. Like I mean, I know that sounds ridiculously obvious, but like you're basically writing yourself a story when you're trading. Like, and that's why I annotate so much, because I'm writing the story. I want to see these things fail. Like I want to see, when we're looking at sell side delivery, I want to see up close candles act as resistance as well, not just the fair value gaps. I want to see every up close candle that breaks lower act as resistance.
Mhm.
So like you're basically creating yourself a roadmap, and any sort of piece of information, like if I wanted to see prices go higher, I'd want to see down close candle support price. But in this instance, it's that, or I want to see inverse fair value gaps. And if those things aren't happening, I have way less conviction in the trade.
Yeah, that's solid. Um, cool. I think that's a majority. Do you guys have any other questions in the chat? We have one that says, what's the average risk reward setup for plays like this? Let's say during the New York AM session. I think that it's really, I think it's too broad of a question because I assume just the way you trade, like your risk reward is going to vary it's just based on market structure. So it's like sometimes you're risking, I'm sure, like 10 points, sometimes you're risking 15 points. Like it's going to vary. And
Mm-hmm.
obviously, in a setup like this, like the risk reward is huge because
Yeah, it's
the
very
market's,
asymmetrical.
yeah, it's asymmetrical. But I think the big takeaway, like with ICT models like this, is if you can spot like these, like, these buy side or sell side areas, and kind of change the thinking of, if you can go back, could you go back to that one slide real quick, actually, of the support resistance that you had up? This is near the beginning. Yeah.
That
Okay.
one.
So yeah. So this is actually something like really, really beneficial for everyone, I think, to look at when it comes to futures, just in general. Stocks in play, it's not as relevant. This is mainly just with futures, but like this concept of finding liquidity down here, and about the, like, where everyone's like, oh, well, this is support, or like, or like this is resistance. It's like these areas, when we come into them, a big part of what we need to do as discretionary price action based traders is we need to literally watch what happens, because quick
Mm-hmm.
step dumped is like, yeah, it can, like, you don't know what's going to happen. You need to wait for the reaction, kind of see what's happening first. So a huge takeaway in this type of model that just really, really helps when it comes to liquidity is watching how price reacts near those lows or near those highs. And sometimes you're going to take a stab at it and you might be wrong initially, and it might make one more small like blip below, and then you actually have an ideal entry, and like that shit's just going to happen. And because, like, you're trying to basically snipe a bottom, but knowing what you're looking
Yeah.
to snipe, and knowing like exactly like this type of formation where you're like, okay, we're going to sweep under real quick and like, we pause a little bit on the tape. This is where like a lot of price action, just tape reading comes in. And, when we slow down, we're like, okay, price is slowing down. You build that intuition of like, it's slowing down here. If it's going to flush, it should have already flushed. Okay, I need to be considering that this is going to reverse.
Yep, especially if you're trading some sort of like, if I'm ever buying a break like that, like that's something I do. I'll buy this, but I need to see a certain thing happen. I need to see it at least get me to break even pretty quick, because that's an indication that I look for, because I'm buying the low. Like I want to see it recover really quick and hold it.
Yeah.
And sometimes, yeah, it might blip you out a little, but yeah,
Mhm.
you're right. It's literally watching the reaction. And like if you have a higher time frame thesis, it makes it a lot easier to be bullish when it's breaking lows. Like let's just say, imagine there's a fair value gap underneath here, because that's something that happens a lot. If it's a low that breaks and a fair value gap, I'm buying it all day.
Yeah. Yeah,
I see
exactly.
Jeff asked a question. Volume was a factor. So this is what I did this year. I took volume off my chart and I never looked back. So my thought process is like, I thought it was going to be like, because when I first heard about people not using volume, I'm like, you guys are insane. But I said the same thing when I heard about people not using time and sales. I thought that was crazy.
Mhm.
And then I stopped using time and sales and I'm like, wait, why did I waste all this time using this shit? Like it actually didn't help me. Like I didn't get worse. And that was the big question. Like, would I get worse at reading price if I stopped looking at volume? And the answer is no. Like it does not matter. I mean, see my charts, they're all based on time. So like something like, let's see, there's time windows. So like this, you can see the New York Open for equities. There's like a lighter shaded area for an hour before equity open. And then this until about noon is a darker color. So these are two time zones that I'll trade. And then I have one after lunch that's just a different color. So like I'm focused on time. And when you align with time, you get all the benefits of what volume would tell you. And like days where it's like low volume, like bank holidays, those are just holidays. So like that's time as well. Like you don't even need volume to know that like a bank holiday is not going to have volume. You just need to know the time. So as far as that goes, like I stopped using it and I was like, is this going to make a difference? And
Mhm.
I think that was like, I don't know, like November. And like I haven't noticed a single difference. Like and that means I've stopped using indicators. I don't use anything other than price. And I'm able to identify turning points. And like my logic is if I can simplify and it still gives me the same, or like if it was at least the same result, I'd be in. But like I'd say it's improved my trading because I'm able to focus on what we're actually trading.
So that actually leads into a really good question that Doran just asked is, does this work best in the 10 a.m. to 11 a.m. and 2 p.m. to 3 p.m. timeframes? I think, kind of a broader question is like, how important is time when it comes to, this model of reading price? Because I personally have some opinions on this and I think you agree with me. So I want to hear what you have to say.
Yeah, time matters a lot. So you mentioned a few of the like silver bullet times. So like 10 to 11 is a pretty sweet time. The first 30 minutes of the market open, it can be difficult if you don't have like a daily bias. You might struggle with that. So sometimes it's better just to not trade that first 30. And especially if it's like a Monday, maybe just don't do anything for the first 30. So like that's another element. If there's no news, if there's pending news, if there's like a holiday or just any reason for the market to be slow, just assume it's going to be slow. And then yeah, like time matters a lot. So like after lunch, like you're going to want to wait. Sometimes you miss a move. Sometimes there's a move during lunch where like you normally don't really want to trade lunch just because it's normally pretty shitty. But sometimes things are a little out of alignment. And like I'd say today, like the times of things are a little off. Like we saw a rally right after lunch, which isn't normal per se. Like I don't see it all the time. So things like that, sometimes you technically will miss out on a price run, but for the most part, it's pretty much better just to wait for the certain times of day.
Yep, solid. That's like my biggest thing is part of my system and structure is like I don't trade the open at all. Like I literally like I sit out like a minimum, like a bare minimum. And it's funny because the more data I collect on this, and this is something where like you guys, if you don't playbook and like collect information on like your best setups and what makes sense to you, you have to learn the nuances behind it. And so like time is a nuance that a lot of people overlook. And it's something for me, which is super, super crucial when it comes to trading futures. And I just noticed based on like my system, what I'm trying to build, my edge, that every time I don't wait a minimum of 20 minutes, at least 20 to 30 minutes after the open to take a trade, based on all the data I collect, yes, sometimes I can put up a good trade in those first 5, 10, 15, but more often I am more correct and more on point if I just simply wait. So remember, like this is a probability based game. So the more often you can understand all these small variables of like, okay, well, yeah, this can work, but I know 80% of the time or 90% of the time, I'm going to perform better and work better if I just do this one thing, such as like waiting 30 minutes. It's like, okay, well, if you know that, then control your impulses and don't be a degenerate and just wait. So,
Yeah,
that's
seriously.
a huge, huge part of the game is literally stuff can work all the time because it's the market. You can get rewarded for doing stupid shit. But if you are studying some sort of edge, you have to know what is the probability it's going to work more often than it does not, and what keeps you safe and keeps you out of trouble. And that's a huge, huge part of trading. And if you don't master that, you're going to constantly spin your wheels and you're going to be like, oh, well, this is actually working. I need to do this more now. But it's like, no, like you've been studying what has been working, what works. You're just being impatient now and like kind of getting away from your process, what you're trying to do. So,
Yeah, I mean that's a great point. I mean, if we obsess with like what like works occasionally, like there's occasionally Asia rallies like crazy.
mhm,
And for those who don't know, Asia is normally a very small consolidation on almost every single day. But that one day that Asia rallies, if you base your model off that, you're in for a lot of headache because more often than not, you're going to be in like a 5 point range on ES or something. So, like, there's just a certain, like, we can get into more advanced topics and discussions on the stuff, but there is a clock to the markets.
mhm,
Things happen on a time-based delivery. Like, and that's the great part about this. Since I've started to focus so much on time, I have a good understanding of how long a trade should take. So never in my life am I holding through like drawdown if we're coming into lunch. I already know like unless lunch is primed to give me my target, it's okay, it's done, you
mhm.
know? And that's the cool thing about also just entering on a retracement. Because if I'm wrong, guess what? The next candle hits my stop.
Yeah.
I don't have to wait 20 minutes. It's just boom. But
That's
if
not,
you're chasing price, sometimes it will go sideways and then, but
mhm.
yeah.
We got one more question. What is the average time from a fair value gap retracement to opposing liquidity pool?
Great question. So I can simplify that into there's two types of price delivery. You'll have a low resistance liquidity run. I mean, what it sounds like. Very, very fast. So, like, that's the example I brought. Very, very clean price delivery. This is an amazing trade to take. They don't all work that way sometimes. Sometimes it'll come down. Let's see.
Elevator down, stairs up. Yep, we all
Yeah,
know.
so sometimes it'll come down and then it'll retest the fair value gap, and then it'll go and retest the fair value gap, and then go and retest the fair value gap. Like this happened to me I think last week because this was right before lunch and I was getting short and it gave me a little pulled back, gave me a little pulled back until 130 and then it released 100 points.
Yeah.
It was like it was the most insane thing I've ever seen that just like I'm like that I'm convinced because it was at 130 that the price run started and it was a rapid run lower. Like it was 80 handles in like 20 minutes or something. Like it was the most expedient price delivery I've ever seen.
I think
But that's because it was primed to move lower.
I think the last thing to be said on that is like, when you have a scenario like that, is like really what is your style of trading of like what's your personal style of trading, right? So it's like
Yeah.
for me, like I don't want to sit there like, yeah, do I want 100 handles? Of course, but like if I can knock out 20 to 30 based on that quick move, like I'm just content with that. I don't want to sit through the rest. Like, like always a cool thing I think is like when in doubt, like sell into the lows, like,
Mm-hmm.
sell into the highs. Like the odds of retesting current structure that's already been established is much, much higher than traditionally breaking a brand new high or breaking a brand new low. And so it's like really that is something through just like consistent screen time and practice that I've learned about the markets a lot is like, you're going to get a retest of intraday structure a lot more, but the odds of breaking brand new highs or breaking brand new lows, like, yeah, they happen, but they're not going to happen as often. So it's like, determine how greedy you want to be. That's kind of what
Yeah.
it comes down to.
I mean, partials always pay. So like I found that example and yeah, you're right. You always want to be selling into like what price gives you. You never want to be on the edge of your seat. And that's why I don't like a trade like this, because had I left my initial stop, I would have stayed in on my trail. So I sold one into prior day high and then it rallied and it took my trail. And then we get into, I believe right here is about 115, 120. And we see that once it got past New York lunch, there is maybe one or two up close candles from 18,100 to 18,000.
Yeah.
Like that's an insane trade. And it's based on these fair value gaps. Notice how there's never a body that closed above the fair value gaps. And
Mm-hmm.
that goes into what I was saying earlier. When there's two fair value gaps, sometimes you got to use both. So like you got one right here and
Mm-hmm.
you have one right here. So I entered on the lower one and then it gave me an entry on the upper one. So I took it. And then what I do, I sold into a discount array, which is a prior day high,
Mm-hmm.
and it recovered and churned until time permitted the delivery of price. Like
Yeah.
examples like this make you fanatical because you go, how the hell could I have known that? But I did, like I knew where it was going. And part of my understanding is that during this time of day, it's normally lower probability. And what did it give me? It gave me a lot of hoopla and then it dropped.
Mm-hmm. Mm-hmm.
So it's just, you'll
It's
build it over
perfect too.
time.
No, continue.
What was
Sorry.
that?
I was gonna say it's like this is such a good example too of like, you selling into the break of or
Yep.
basically the retest of prior day high. It's like that is the safe trade. And then once you see this higher low being put in, like and especially based on
Mm-hmm.
what time of day it is, you have to go into high alert. So like you trailing here is the right thing to do because like again, you didn't know this was gonna happen based on the
Yeah.
time of day. So it's like it just really how much headache do you want? Like that's always the question.
Yeah, another 20
Headache.
minutes of just like nail biting. So
Yeah.
like yeah, you have two options. Like one you can leave the stop up where it was and you can cover costs, but then you end up with a break even trade if it takes you,
Mhm.
you know? Or you can profit on one and then you can stop at break even
Yeah.
and you profit on one. So like there's many ways to cut it, but partials always pay. And that's a big premise of this model is like just understanding logical points to sell. Like I think that's a universal thing. It's these trades you can get a little obsessive about being too perfect, but like I mean, even from here to here, that's an amazing trade. I mean, 30 handles, that's an amazing trade. But this was the level I was obsessed with.
Yeah.
And I when I said right here, I put in the chat, I said we're going to see 18K.
Hmm.
And it gave it to us in like 15 minutes.
Yep.
So that's the power of this stuff, understanding where price is going to turn. Because, like I said, if you end up in the right area at the right time, you just hang on.
Yep.
But sometimes it doesn't let you hang on for that long. But yeah,
And that's trading. So um cool, man. I think that we're gonna like kind of wrap it up here. It's just about an hour. Um
cool.
Thank you for the webinar. That was great. That was super informative. All your charts and stuff in the chat, everyone's been loving it. It's just been helpful, helpful as fuck. So it's like, again, really appreciate you putting that on and kind of clarifying that stuff because I know for a lot of you guys out there, ICT stuff, even for me, like it's can be confusing as fuck. So understanding the basis of this, of liquidity and fair value gaps is like the perfect intro. So I think this went awesome. Um, Chris, go ahead and say where. I mean, everyone probably knows where to find you, but tell them where to find you.
Yep. I'm on Instagram, Cypher the Algo, Twitter. I don't tweet or X or whatever. But
Mhm.
yeah.
Cool.
All right. Thank you, everyone.
Oh, thanks, guys. Appreciate it. As always, keep keep making gains and let's keep learning from each other. And don't go into tomorrow all hot and heavy about like looking for every single fair value gap. Take time to digest this information. I remember right after Chan's webinar, I was like super focused on trading YM, and I was like, I've never traded YM before. Why am I focused on this? So it's like like take time to like this is information. I know it can be exciting and like you're like, oh, I see this, but like take time to see it, watch it first, see how you can incorporate that into your own trading system. Because again, like confluence of what you're trying to build and some other theories that really is just what adds conviction, because it's like, it's not just one size fits all. If you have something like, I trade a lot of volume pointed controls, I trade a lot of VWAP. And so like when I see something line up with ICT concepts of fair value gaps and liquidity, and it's trading against my volume pointed controls or trading against my VWAPs or like key levels I have, it just adds conviction to my thesis. And, it's just like, always like, how many boxes can you check based on like your thesis? So just remember that, everyone. Yeah, good stuff. And we'll wrap it there. So
Yeah, thanks everyone. Yeah, definitely collect your examples. Don't take my word for it. Give it time. It doesn't
exactly.
happen overnight. Like if you don't give it time and one of these things fails on you, you're gonna be like, see, I knew it. Like you gotta have the proof. You gotta prove it to yourself that this stuff works. And like that's the biggest takeaway. Spend time with it.
Exactly. Cool. Right on. Thanks again, Chris. Really appreciate it. We'll chat in the chat, guys.
Cool.
All right.
Later.
Later, everyone.